Namaskar and welcome to the seventh part of Fundamental Analysis. From today, we will talk about the analysis of financial statements. Whichever company you want to analyze, be it a listed company or a startup, it is mandatory to analyze the financial statements of that company. This is because numbers reveal a lot. To be a good investor, you have to know how to analyze financial statements. Once you learn how to analyze financial statements, you will be able to do it very easily. There are three main parts to financial statements: balance sheet, profit and loss statement, which is also called income statement, and cash flow statement. We will start with balance sheet. Before learning how to analyze balance sheets, we will request you to go through the videos on balance sheet that we had uploaded on YouTube a while back. The titles were How to Read Balance Sheet on Money Control Part 1 and How to Read Balance Sheet on Money Control Part 2. Please go through these videos because here we have explained the meanings of the terms used in the balance sheet. Along with that, we have explained why a balance sheet is called a balance sheet. What are the meanings of the terms included in the balance sheet? How the money received from shareholders become a liability for the company and everything else. So today, we are not going to talk about the terms of the balance sheet and its basics. Today, we will talk about how to analyze balance sheets. So, if you watch the two videos first, it will be easier for you to understand today's session. When it comes to the analysis of financial statements, the first question that comes to our minds is, where can we find the financial statements? To find the financial statements of any company, you will have to go to that company's website and click on the section on investor relations. For example, if you want the financial statements of Reliance Industries, then you will have to go to the Reliance Industries website and click on investor relations. After clicking on investor relations, you will see a section on financial reporting. If you click on that, you will get the financial statements for Reliance Industries. Similarly, we are going to analyze ICICI Securities. To get the ICICI Securities financial statements, you will have to go to the ICICI Securities website, icicisecurities.com, and click on the About Us section. After this, you will see the section on Investor Relations. If you click on this, you will get the financial statements for ICICI Securities. Financial statements are of two types: consolidated financial statements and standalone financial statements. It is important to know the difference between the two. Standalone financial statements are only the financial statements of that company. The subsidiaries of the company are not included here. For example, if you look at the standalone statements for Reliance Industries, then it will include only the main business of Reliance Industries. It does not talk about the performance of the subsidiaries like Reliance Jio, Reliance Retail, etc. In the consolidated statements, the company's subsidiaries are added along with the main business. So, the consolidated statements on Reliance Industries includes the main business along with the subsidiaries such as Reliance Jio, Reliance Retail, and others. While analyzing the financial statements of any company, you will have to consider the standalone statements as well as the consolidated statements. Why? This is so that you understand how the main business is performing and how the company's subsidiaries are performing. If you analyze the last couple of years for Reliance Industries, then you will see that the company's standalone business is not performing that well. The company's subsidiaries are the ones who are performing extremely well. The performance of Reliance Jio and Reliance Retail have been absolutely outstanding. So, in the consolidated statements of Reliance Industries, the contribution of Reliance Jio and Reliance Retail are increasing. So, let us start with the balance sheet. The analysis of balance sheet is very important because the analysis of balance sheet reveals a lot about the company. The amount of reserves and surplus with the company, the proportion of profit that is getting reinvested in the company, the amount of debt upon the company, whether there have been any related party transactions, whether the debt is within a limit or is crossing the limit, and other similar things are revealed from the analysis of the balance sheet. There is another thing about the balance sheet that you should know. That is, the balance sheet is always for a specific date and not for a specific period. This means if the balance sheet is of 31st March, then it is of that particular date. This means on that particular date, the company had that much assets and that many liabilities. Balance sheet is not for any particular period. That is, it is not for 3 months or 6 months or 1 year. On the other hand, the profit and loss statements are for specific periods. That is, profit and loss for 3 months, 6 months or 12 months. So, always remember that balance sheet is not for any particular period. It is for a particular date. There are two main things in a balance sheet: assets and liabilities. Assets mean the things that are owned by the company. Liabilities mean the amount that is owed by the company to others. In the beginning, the two videos that we have told you to watch have covered all the basics on assets and liabilities. So, today we will not talk about that and will directly come to the analysis. Here we will focus completely on analysis. Let us start with liabilities. There are basically two types of liabilities: shareholders fund, which is also called shareholders equity and liabilities, which can also be referred to as external liabilities. There are two components in the shareholders fund: share capital and reserves and surplus. Whenever a company issues shares, it decides a face value for each share. For example, rupees 2, rupees 5, rupees 10, etc. Face value is just an accounting term. You don't need to give much attention to it. Let us assume that a company is issuing 10 crore shares in its IPO. They have kept the face value for each share at rupees 10, but the same company is selling the shares to people at the price of rupees 1000. So, on selling 10 crore shares at the price of rupees 1000, the company will get rupees 10,000 crores. The face value of one share is rupees 10. The company has added a premium of rupees 990 and sold the share at the price of rupees 1000. So, if you multiply the face value with the number of shares issued, then you will get the share capital of the company. Then, if you multiply the premium added with the number of shares issued, you will get the share premium of the company. This is included in the reserves and surplus. Here, the company's share capital will be face value, that is rupees 10, multiplied by number of shares issued, that is 10 crore, is equal to 100 crores. And share premium will be premium, that is rupees 990, multiplied by number of shares issued, that is 10 crore, is equal to 9,900 crores. So, 100 crores will be the share capital and 9,900 crores will be the share premium, which will get included in the company's reserves and surplus. In reserves and surplus, apart from share premium, there is one more thing which is called retained earnings. Let us see what retained earnings is. After dividends and share buyback is taken out from the net profit that is earned by the company, the amount that is left is called retained earnings. This retained earnings is included in reserves and surplus. Retained earnings is a very important component. If the company has good amount of retained earnings, then it can use it for expansion purposes. The company can expand properly on no debt or very less debt. To analyze retained earnings, you will have to check the rate at which retained earnings are increasing every year. While analyzing financial statements, it is important to keep one thing in mind, and that is, it is not enough to analyze the last 1 to 2 years. You have to analyze the financial statements for at least the last 5 to 7 years. Here, there is a column called Notes. You can see that the number 4 has been mentioned before reserves and surplus. To understand reserves and surplus in detail, you will have to go to note number 4. You will get this at the end of the balance sheet. Let us go to note number 4 to see how retained earnings are calculated. As we mentioned before, subtracting the dividend and share buyback from the net profit gives the retained earnings. After coming to note number 4, you can see surplus in point D. Here, you can see add profit after tax for the year. You can see that in the financial year 2018, the company made a profit of rupees 557 crores. All these numbers are in millions. I'm converting them into crore for you. In the financial year 2017, ICICI Securities made a profit of rupees 338 crores. As you can see below, in the financial year 2018, the company has paid interim dividend of rupees 177 crore. On that, the company has paid dividend distribution tax of rupees 36 crores. Once you subtract both these figures from net profit, you will get the retained earnings of the company. In this period, the company has not bought back any shares. This is why you don't need to subtract that amount. As we saw, in the financial year 2018, the company made profit of 557 crores. Out of this, the company paid interim dividend of 177 crores and dividend distribution tax of 36 crores. On subtracting 177 crores and 36 crores out of 557 crores, we get 344 crores, and this is the retained earnings of the company. In this way, you will have to look at the retained earnings for the last 5 to 7 years and then check the growth rate in the amount of retained earnings. Similarly, you can see in the table that for financial year 2017, the company made profit of 338 crores, and out of this, the company paid dividend of 205 crores. Along with that, the company paid dividend distribution tax of 41 crores. So, 338 crores minus 205 crores minus 41 crores gives us 92 crore rupees. This is the company's retained earnings for the financial year 2017. Just looking at the retained earnings for 1 to 2 years is not enough. You will have to check the retained earnings for the last 5 to 7 years and then check the growth rate. So, your homework for today is to calculate the retained earnings for ICICI Securities for the last 4 to 5 years. Calculate the retained earnings and we will continue from there from the next lecture. We hope that you have enjoyed today's session. The analysis of financial statements is one of my favorite topics as well, and I love teaching this topic. We hope that you are also enjoying this just as much. The analysis will continue to get even more interesting from here on. So, we will meet soon in the next part.